Hello and welcome to the course. I'm so glad you're with us. Hi, I'm Steve Ballinger. I'm the creator and the instructor for the course and a long-time successful investor, and I'm very glad you're with us here. As you can see, it's a very big course. We've got a lot of material to cover, which hopefully that's great for you. And the course is designed that you can start at the beginning and go all the way straight through, and it's in a logical manner, so you can do it that way. Or if you are, depending where in your investment journey, maybe you want to skip around to different sections or different lessons, that's perfectly okay. It works that way as well. Whatever works best for you. Though I would encourage you to watch the next two lessons first. They're kind of good foundational ones around can I make money in the stock market and how much, and then also looking at, well, what's the worst that could happen and what's a worst case scenario. So the two lessons that happen after this one are good foundational ones to watch, and maybe the whole purpose, they'll get you all excited about investing in the stock market. A couple other things to make sure how you can consume the course as best as possible for you in this quick introduction. One is you can change the speed. Udemy allows you to change the speed. They change your look every once in a while, but they'll always have a control as far as how to adjust the speed. So sometimes I get very excited talking about stocks, and I might talk a little fast for many of you. Feel free to slow it down to change the speed down if you need to do that. Also, the video quality comes out automatically based on your internet connection and other things, your device, and Udemy takes care of that all automatically. But everything I filmed is in 1080p high definition video, so you can always adjust that as well. If you want, just Udemy automatically streams it to be at the best rate. Also, a couple things. Good to take notes. I would encourage you to take notes as you go through the course. Maybe you hear something, you're like, oh, I heard about this mutual fund expense ratio being above 1%. Might want to look at that. And maybe you're thinking, I have mutual funds. Maybe I want to check that. You just make a little note as far as some things you might want to check, or maybe you want to look at a link or something that's included in the course later. You can do that. So it's good to take notes as you go through the course. And lastly, ask questions. That's a beautiful thing about Udemy is you can ask questions, and I answer every single question. And I encourage folks to ask questions. I encourage everyone in the course to jump in and answer questions and share their thoughts as well too. So click the button that says Q&A or questions at the top there, and feel free to ask questions. Once again, I answer every single one. Okay, well that's it for this short intro. Let's get diving into the course now and learn how we can become great at investing in stocks in the stock market and make some good money along the way to fund our goals and dreams. Well, if I was taking a course on stock investing, probably the first question I would have is, hey, can I make money in stocks? And if so, how much? That would be pretty important to me, and I'm sure it is to you. And the good news is, yes, you can make money in stocks. In fact, stocks outperform things like bonds and cash and other asset categories, so they're a great way to grow your money. I suppose this is a pretty short and lousy class where you said, well, no, you can't. Since it's a good long course, yes, the good news is that you can. So really two big questions we're going to look at in this lesson, which is, can you make money in the stock market? But really, how much can you make? And what's the worst thing that can happen? What's the worst case scenario? So let's take a look at both of those. In fact, let's start with the scariest one. What's the worst case scenario? And if we look back in time, there's really two big ones that really stand out, I think. And one is, what if you bought your stocks just before the Great Depression, like the worst time ever, right before? What would have happened with your money, and would you have recovered from it? And then we'll talk about also the COVID-19 pandemic, something that maybe we've all experienced as opposed to the Great Depression. And we'll talk about these two in terms of, well, what's the worst that could happen, and is it really that bad? So here, looking at the Great Depression, is stock market returns by year. How much money are you making on a percentage basis by year? And so you can see leading up to the Great Depression, which really the big stock market crash happened in October 1929. You can see it was down 9.46 there in 1929, got really worse thereafter. But before that, we had a big run up as far as great returns, kind of like a bubble, right? You've heard of bubbles? Well, it's kind of like they had a bubble, right? And then the bubble burst, and then, there's panic and all that. So if we look at that, and then it got choppy after that. So let's look at different periods if we would have bought in to see what would have happened to our money. So if we started over a longer term, and we bought in at 1924, let's see, we bought some stocks, let's say average stocks, and held it to that 1935 where we started to get some better returns, you actually would have had an average annual return over that period of 14.2%. So if you had 10,000, whatever it might be, dollars, rupees, euros, whatever your currency is, just think of that. Your 10,000, if you started in 1924, would have grown to 29,600.
So think about it. You would have easily survived and done great getting through the Great Depression. In fact, stock markets tend to average about around 10% as far as average annual return. So you would have done even better if you would have started and then held on. All right, well, let's say it gets even worse. Let's say we look at just from 1929 to 1935, right? That we didn't enjoy that big run up. We got in right more of a worst case scenario. Well, we would have lost 2.77% of our money. So our 10,000 would have fallen to 8,200. But if we kept buying stocks during that time we've been buying low, and then we had those great times coming later or all through history, then we would have done even better. But even still, right at the start, and January 1st, 1929, even at the start of that, holding just to 1935, it wouldn't have been that bad. What would have been bad is holding just during the worst period, 1929 to 1932, right? 4 straight years of big losses, an average of minus 20.55. Your 10,000 would have fallen to 3,700. And when we have those periods, that's where a lot of people get out and they lose a lot of money, where other people who invest during that time and keep investing actually will do well over the long term. Again, look at that 1924 to 1935. How well you would have done. Now let's talk about COVID. COVID. Remember COVID when the stock market went crazy and really took a dive early on, especially in February and March of 2020? Well, you know what? After that big dive down, it only took 8 months to recover all the losses due to the COVID pandemic. And some stocks did very well during the COVID pandemic, things that were more COVID type stocks, like Zoom, right? Everybody's working virtually or trying to communicate virtually. So Zoom did very well as far as virtual communication. So there's always somewhere in the stock market where somebody's doing well, even if others are doing bad, and even if the whole market's doing bad. But it only took 8 months to recover all your losses due to the COVID pandemic. So maybe the question is the worst case scenario really all that bad? Is it really all that bad? And I would say, especially if you're a long-term investor, or whether you're buy and hold or you're more of an active trader, no, it's not that bad. In fact, it is very, very good. In fact, let's look at that more likely scenarios. So that's in the past. Let's start a new day and think about, what if we start investing now? Or what kind of returns can we start expecting here? So here's a more likely scenario. Let's say you had invested, right now today you invested 10,000. You had 10,000 laying around, or whatever money you got, you might be only 1,000 or 500. That's okay. There's ways to invest smaller amounts. But let's say you have 10,000. You just want to start right now investing in a broad stock market, like a broad index, like a Nifty 50 of the 50 largest India stocks, or S&P 500 largest USA stocks, whatever, a broad market index. And let's say you invested at 10,000 each year thereafter for 20 years. Right? So start with 10,000 now, and then every year over the next 20 years, just passively putting in my 10,000 and letting it grow. So if you invested, let's say, to compare that with bonds, which have an average return of about 6%, you would have made $421,998. Let's call it $422,000, $422K. That's really good. I'd be pretty happy with that. But stocks, even that percentages that they do so much better, even that 4% better than bonds on average, an average 10% return would have got you to $697,000. And if you held out actually for 30 years, if you did that same program for 30 years, then you'd have 1.9 million. Right? Pretty good. So, and why is that? What is causing this? Well, one thing there's a helping wind. Just like if you're in a sailboat and there's a wind pushing behind you and your boat's moving quickly through the water, you don't have to do much or anything with it. The wind will just push you forward. There's a helping thing behind it. And that's an historical helping thing with the stock market, which is stocks will rise over time. Now, there's periods when they certainly go down in price, for sure. And individual stocks can go way up or way down, and it can be very volatile. But stocks historically rise over time. And this is over a long, hundreds of years period of time. So stocks rise over time. Now, do they have big pullbacks at times? You bet. Think of like COVID. We were talking about COVID in 2020. See how it dropped and then it recovered very quickly? Almost looks like a V, right? Think about like early 2022 is another good example where we had inflation and Russia invading Ukraine and supply chain issues and things were still kind of recovering from COVID, and how that had dropped really down in that period. But over time, stocks will rise over time is the idea behind that. So what I want you to take away from all of this is not only some information, but I want you to feel good. I want you to feel excited and happy and learning that, yes, you can do this. In fact, millions of people succeeded by investing in stocks, and so can you. So can you. Why not you? You can. And the good news is you're going to learn all sorts of things about investing in the stock market in this course. They'll help you to do even better. All right? So I hope that helps you to give you a feel for how much you can make, what's the worst case scenario, is it that bad, and maybe get you excited about continuing on with the course, and let's go on to the next lesson, and so we can be successful investing in stocks as well. Let's do a quick little activity, a little practice session here, and let's evaluate a stock that you may like with a few of the things you're going to learn in the course. It's a big course. We're going to cover lots of topics, but in this part, we're just going to look at a few of the things that you're going to learn to show how you can apply them to a stock that you might already be interested in right now. I'm going to show you using easy and free tools, so there's nothing you have to buy or anything like that. Easy and free tools. We're going to use this to evaluate a stock. And everything we're going to learn here can be applied anywhere in the world with any stock. That's true for the entire course. Anything you learn here can be applied to any stock anywhere in the world. And we're going to look at three kind of areas real quickly. We're going to look at, kind of that bigger strategic stuff, like around a company's competitive advantage, just a couple things from there. We're going to talk a little bit about ratios. That's kind of like the finance part. You might have heard of some of these ratios. And then we'll talk a little bit about charts, right, and technical analysis. So don't let it scare you off. It's very easy that we're going to learn here. Look at this baby's doing. He's buying stocks right now. Oh my gosh. If he can do it, we can do it. So let's start when you're looking at the stock that may interest you. Let's look at competitive advantage. What is that stock that you're interested in? Just think to yourself, what are they good at? How do they have an advantage over their competitors? Or maybe they have a disadvantage in some cases. And let me start your thinking by looking at just two areas. We talk about later in the course about the moat, kind of like what protects a castle is the moat. Well, competitive advantage is what helps protect your company from its competitors or helps it to do well against its competitors. So think of your company and decide, is it a low-cost leader? Like they do the lowest cost, or they offer something like high quality or high service or lots of services, and so they're differentiated somehow. And what about brand name? Do they have a strong brand name in relation to that? Are they well-known? Are they well-respected? By the way, this is only a couple things that make up a moat. We're going to learn a whole big section on that coming up. But just think about, for now, low-cost leader, or are they real high quality, or do they have a strong brand name? So start with that. For example, like Apple was not low cost. For example, their iPhones are actually quite expensive, but they have a strong brand name, and they certainly have a reputation for quality and service. And then in terms of ratios, really all ratios are trying to do is use some financial numbers and help you decide, is the price I am paying for a stock good in relation to something, some type of number, some type of measure? Is the price I'm paying for a stock good in relation to something? And I want you to start, and I'm going to show you exactly how to look these up, by the way. So don't worry about that. I'm going to show you step by step how to do it on a couple free platforms. What is the couple ratios would be? One would be the price, the stock price relative to its earnings or its net income on a quarterly basis. Or what's the price of the stock relative to its revenue or sales, right? So key thing about company success, right? Are we making money? Are we growing our sales? And what's my stock price in relation to that? Is that good for us as an investor? Is that a good thing to buy now? So we're going to look quickly at PE, or price to earnings, and PS, price to sales. We have a whole big section on ratios too, so there's a lot of ratios you're going to learn, and you can use the ones that work best for you. And then lastly, we'll do a quick thing around technical analysis or charting. Particularly if you're interested, maybe I want to be more of a day trader or more of an active trader, getting time into this charting section of the course will be real important. So I want to give you a little introduction to that too. If you look at, let's say this graph here, these are just different candles or things that look like, represent the different type of day thing, for example. So here is an example. We're going to look at moving average. That's the indicator we're going to look at based on we want to do something in relation to what's happening to prices in relation to the moving average of these prices. So if we look, we're going to learn all about candles, all sorts of things, but if we look at these different kind of candle looking things with these wicks sticking out of the top and on the bottom, and let's say each of them represents a day. Some days the stock is up, in green, and some days the stock ends up being down. And that line that moves between them, between these days, is the moving average. And when it crosses the moving average, that tells us something whether a stock might go up or go down. And I'm going to demonstrate all this for you here coming up in just a moment. So, for example, if we look at number 1 there, we can see that the stock price crossed downward, down from across that moving average at, maybe 9 or 14 days looking back as far as a moving average of the prices. The current prices crossed down from there. And then something happened as it goes down. And then later at point number 2 is when the stock price crosses above that moving average. And so what we're really looking for from a charting aspect is this is giving us an indicator or telling us something. Nothing's perfect, but it's trying to tell us something. And what's it trying to tell us something? Well, and we'll get into detail on this, but if we look at that number 1, what it might be telling us that when it crosses to the downside, that a new downtrend might be starting. You see the little candles or the prices that come after that number 1 price, where it says the 1 above it, how they went downward? That's what it's trying to tell us, that when we cross down across the moving average, that the trend will continue. It's a continuation indicator that the trend will continue downward. By the same token, when it crosses above, like at point number 2, that may be the start of an upward trend. And in this case, it actually went sideways for a little bit and then started an upward trend. Again, nothing foolproof of moving averages or any kind of technical analysis, but it can be a very strong indicator of what might happen. So we're going to take your stock, and I'm going to demonstrate with another stock so you can see how I look up all these numbers and how to figure this all out. But we'll look at that competitive advantage. We'll look at those couple of financial ratios, just the price to earnings, price to sales, and we'll just look at that moving average for the chart part. Again, we have a big section, and all three of these have their own big sections. They're like their own courses within the course. And that'll help you give you a feel for maybe a stock that interests you, how it's doing. Okay, and the company we're going to look at is actually Wipro. You may have heard of them. They're a technology company out of India. You may not have heard of them. And we're going to look at them as far as evaluating a stock real quickly. And you can do this for any stock that might be of interest to you. Again, Wipro does a lot of different IT stuff in a lot of different areas here you'd see under services. They're a big IT company. In fact, if we looked at it from that competitive advantage standpoint, in India and other places in the tech space, people know Wipro, right? They know Wipro. Even if you don't know them, they are very much a brand name in their space. And then in terms of differentiation, they may or may not be low cost, but I would say they're more having a lot of different services, a lot of different things that they offer. So that's really they differentiate, right? They can be basically involved in a lot of different services in a lot of different industries and doing a lot of different things around the IT space. So Wipro is who we're going to look at here. And I would say certainly from a competitive advantage standpoint, lots of services, lots of industries, big player. Okay, so now we got that as far as kind of a little bit of their competitive advantage. Let's now look at their stock. And I'm going to use 2 sources for that. I'm going to use Yahoo Finance, which is a really good, easy, free tool to use, but it may not be in every country. So another one you can use too is investing.com, which is very good for international, or for, I should say stocks around the world. They look at stocks more across all over the world, and you can actually look at things in more of your local currency. So let's look at Wipro in both these things really quickly here. So I just need to type in the company name to find them, Wipro here. And this will be in dollars because this is going to be on the NASDAQ, on the U.S. Stock Exchange here. And I'm going to show you how you can look at it in rupees or in other currency as well, too, using investing.com. So this is what it is right now in dollars. And we wanted to look at its price to earnings ratio. So here it's actually very simple. It's a very common thing here. And we're right here at PE ratio, price to earnings. TTM stands for trailing 12 months. And we know its price to earnings is 19.72. All right, so at this point, that doesn't mean anything to you until we get to that lesson. But let you know that the average price-earnings ratio tends to be around 25. So if the number's lower, that's better. So lower than 25 is good. It's not really lower than average. But you want to compare it to its peers or its industry as well. So a tech company like Wipro might have a higher price relative to its earnings than maybe like a utility company that does like electricity or heating. So 19.72. So that's favorable. favorable. For a tech company, that's actually favorable. Now we want to look at the price to sales, which is nowhere here on this first summary part on Yahoo Finance. So when you're looking up your own company, you would find your PE ratio here, and then we're going to find price to sales under statistics. So you see where I went under statistics here, and then we're going to go under these different valuation measures, and you'll see P to S down here, price to sales, and we can see the current price to sales is at 2.55, and then you can look back each quarter. So these are all different quarters, and you can see that price to sales number has come down. That's a good thing. You know, a price to sales less than 2.0 is very, very good. This is actually fairly attractive for, again, a tech company at 2.55, but if you're looking at something that's less than 2.0, that's excellent. And you can see the trend where the price relative to its sales has come down. Again, if we look at that price to earning ratios, we have trailing, like the last 12 months, trailing 12-month or TTM, or a forward-looking, what do they anticipate the price to earnings ratio will be? Again, the lower the number, the better when you're looking at price-related type ratios, like price to earning, price to sales. We're going to learn about like price to book. That actually is a really attractive for Wipro. That is an attractive, at this moment in time, attractive price to book. Anything under 3, and certainly anything under 1.0 is very attractive from a price to book standpoint. Looking at what's the company worth from an asset standpoint. But I don't want us to get distracted by that. I just want you to know that that looked pretty attractive there. So that's its price to sales and price to earnings and price to sales, and how you look it up on Yahoo Finance. If we were at investing.com, same thing. You can put in Wipro, or if you know its ticker symbol, you know that maybe it's WIT or whatever, or WIPR. I'm going to show you something here. So Wipro here, you can see there we are at Wipro. Now, one thing to notice here is I chose the one for the New York Stock Exchange, right? This is an ADR. We have a whole section on investing internationally. So for me, this would be an international stock out of India. So that's what's called depository receipts. If you were looking at stocks outside India, or in India, it might be IDR, India depository receipts. But without getting too confusing there, this is traded at this price in the New York Stock Exchange. But stocks can change. This is an Indian company, remember, can change on multiple exchanges. And investing.com is nice, where I can click on this and find the different exchanges it's traded on. You can see the flag here, the Indian flag. It's also traded on the BSE and the NSE. These are two different stock exchanges in India. It's listed on both. Just like you have the New York Stock Exchange or the NASDAQ or different stock exchanges, Frankfurt, all over the world, you also have that with stocks. And if I was to change that from a New York Stock Exchange, you see the price here is in dollars. But if I say when I went to the BSE, now I'm going to see that in rupees. See here, INR in rupees, right? And you can see how that number changed. But the ratio should stay, relatively the same, because it's, ratio is a ratio. So then for investing.com, I just scroll down and we get the same kind of summary deal here. And then right here, price to earnings ratio. And sometimes they can be a little different, slightly different between, services where they pull their numbers. Don't let that bother you. That's okay. If they're slightly a little different, they're still directionally pretty accurate, all right? So price earnings I find here, and then if I go up to find that price to sales on investing.com, I'm going to go under financials. I'm going to go under ratios. Again, do this for your company that you're interested in. I'm going to go under ratios. I'm going to scroll down here, and here you can kind of see some of those different types of ratios out here. And here's my price to sales. And the nice thing with investing.com, it shows relative to the industry, right? So, 2.51, a lower the number is better compared to 4.63. That's good. We want that number to be lower than the industry with any kind of price to whatever, price to sales or price to earnings or PE ratio. Just like this is lower than the industry too. So that's why I was saying, even though some things might look a little high, it's still really good compared to its industry. And that's a good thing to do. Compare it to industries, compare it to other stocks or competitors you're looking at. Remember how I got a little excited about that price to book being low? This is its MRQ, our most recent quarter, of 2.99, 3.0, same thing. Industry average about 8.83. So Wipro, a very well-known, established company, right now relative to its book value, what's the company worth in terms of all its assets, if you sold all its assets off? Very attractive. Not too bad, actually, and pretty attractive from a price to sales and a price to earnings as well. All right, so that's the ratios. Now let's go back and look. I'm going to go back to Yahoo Finance, and let's go back and look at its chart. All right, and we're going to look at that moving average. We're going to talk about that a little bit here to give you a feel for technical analysis. Particularly, again, if you want to be an active trader, technical analysis will be very, very important to you. And so take a good look at that section coming up. I'm just going to go, this is the daily, chart. I'm just going to go full screen here. And this is going to bring up a more complex chart, right, for the last several days here. And I can check it by saying, okay, my interval is a day. If I was a day trader, I might meet that interval at 30 minutes, right? And see how all the lines changed everything. All these little dots here and everything kind of changed, kind of squiggly. So that's looking, because that's based on an interval of 1 minute versus 1 day. I can also change how the chart looks, right? This is the prices are changing here on this daily basis. And down here is like volume, like how many trades are there. So we're just going to focus on this part, right? So this is the price, but let's say instead of being a line chart, I want to change that to more like I could change it to an area chart so you can see how the area, the prices change. A better one than we're going to learn about is like candle charts, and there's different types of charts. And you can see here how we've got different prices going up and down over each of the different days, and we can go back in time. You can either use your plus minus here. Oops, excuse me. I'm using my plus minus here to go back in time, or I could use my mouse and my scroll on my mouse to move things around too. So now let's add this indicator, right? So this is all these different daily prices here. So let's add my indicator. I'm going to go under indicators here, and I'm going to choose moving average. It happens to default to it there because it's a very popular indicator. But let's say I could also type it in and find it that way. And there's different types of moving averages, but you want simple moving average or just plain old moving average. So we're going to choose that. The period is how many days are we looking back? So that's defaulted to 50. That's too long. Let's say we're just going to look back 14 days. That's a common number, 14 days of average prices over the average of the last 14 days. And then we're going to use that to tell us something to do. We're going to look at the close. How did it close? As opposed to the open or the highs or different things. What was the ending close of the day? And again, we're using a simple moving average versus other ones like exponential and weighted moving averages are popular too. And we'll talk about those. And you can change the color here too if you don't like purple. You can change whatever color you want. So I'm going to choose this setup for 14 days, closing moving average. And now there's this line that comes through, right? You see the line coming through? I'm going to zoom in here. And you can see right back in here where it went below the line, right over here. That's an indicator that we might start a downtrend. We might start going downward. And in fact, that's what we did. See how all the prices now are lower and they kept going lower for a while? In fact, this is a good spot. Let's focus on this spot right here. So you can see how the prices went low. Sorry about that. So the prices went lower after we crossed right here, versus that if we crossed right here when we went upwards, we went up for a little bit and hung in there, but then it went back down again. See, sometimes it doesn't pan out, but it's an indicator that it might go back up in price. So this showed that it might go down in price, and it did for quite a long time from compared to where it was here to right here. That's a long time in terms of price going down, and then it went up, but then it didn't hold it and went back down again. So then when we're investing now more recently here, if we're looking at this chart, now more towards the end here, see how it went above here and then came back down, but it stayed above it. So this was a buy signal. This was an outlier here. But you can see, what we're looking for, if it crosses to the upside, we're expecting prices to continue to rise, or that would be the hope, versus if it crosses to the downside, then we've got prices that might be falling is the idea. In fact, if we just quickly, I'm just going to quickly draw a little line here. Like, let's say we were at this peak here, and I'm just going to draw this line. You can see how this went down, how this is going down through here. In fact, let's, instead of just a regular line, I'm just going to make it a trend line. We'll put another one line here, the trend line. And you can see how it went down 8.4% down from here to about here, right? So this is like this downward trend type thing. But then when it crossed above, if we were to start, let's say for fun, we'll start here. this is an upward trend line, and you don't have to do this. We're going to learn about this. Don't worry about this. I'm going to show you how to do this later in the course. But you can see this is an uptrend, and then it was kind of confirmed when it crossed this moving average. So right now, just when you're looking at your stock, just think, is it above or below the moving average? Is it going to go above? Is it going to go below? That would impact whether you're going to invest or not. And the hope is that it would continue along the trends, whether it's going down for a downtrend across that moving average, or whether it's going up over an uptrend here. And nothing's perfect. See how this outlier went down real quick, but then it popped right back up again. So nothing's perfect, but that's how we'll learn about how to make better choices with these things. And then quickly with investing.com, just I want to show you where it's at, because we just went through kind of lengthy there, but just go under chart, and then it'll pull up the chart for it, and then you just go this little lines here to break it full screen. We'll close a little advertisement. You can see how it's got these line chart here. We want to change that to candlesticks, so we're just going to change that to candles, and same deal. Now we can see our candles, and now we want to put our indicator on there, and I'm just going right here where it says indicator, so this little bar with the line thing, and it won't default to that moving average as a popular thing. We have to go find it. So I'm going to just put in moving average, and you can see there's different moving averages. We just want the basic moving average, or if it's a simple moving average, it's the same thing. This defaults to a 9-period moving average. I can go under here, under where it says format, and I can then change that length from maybe 9 days or 9 periods to 14 or 20 or whatever. In fact, let's use 20 just for fun, right? And we'll click OK, and now you can see the same thing, right? This is our moving average where we're going. Let's zoom in here. Like here's a good example where we're moving above, or this is where we were before, moving above and below the moving average, those kinds of things. So that's a quick little technical analysis thing as far as how to use charts. And make sure it's default to day or hours or minutes, whatever you want it to be. So, but right now this is days, and we're looking at moving average. And again, if it crosses, here's a better example. If it crosses below where we were before, if it crosses below the moving average, that could be the start of the downtrend. Right? So could be the start of a downtrend. That doesn't have to be, but it could be. That's what it's trying to indicate to us. And then when it crosses above, which this didn't, it sort of got a little bit above, but then went back down again. But once we got a nice firm breakout here, in terms of that crossing above, fully kind of crossing above, now we saw that we were really on this potential uptrend here. And if we bought here and sold here, well, then we made some money, right? So that's technical analysis in terms of some basic charting stuff you can do. And again, if that kind of freaks you out a little bit, you don't have to worry about it, because you don't have to use it. You can use the qualitative analysis and the ratios, especially if you're a buy and hold investor. You never have to look at the chart. But if you want to be more of an active trader, then you're going to learn a little bit more about charts and different things we can use in addition to moving averages and trend lines, chart patterns. We're going to learn a whole bunch of stuff. That'll be a really important section for you. All right, so try these things out with a company that interests you and see how it goes, and maybe compare it to its competitor. Is its price and earnings and price to sales higher or lower than the competitor, and what the chart looks like too. But again, this is all kind of optional right now. This is a preview of what we're going to learn. And if this seems a little bit challenging, don't worry. We're going to learn it step by step. And then you'll look back at this lesson and say, oh my gosh, that was so easy. And that's the idea behind it.